Rick, we're a long way away from any of this actually becoming policy. There needs to be a period where they will debate what is on the table. Then there needs to be a period, I would assume, of negotiations with the Chinese. And yet the volatility story has really picked up, but in one place, in equities. And it's not bleeding out. And I'm trying to figure out why. Why?
So I think there's a couple of things. First of all, I think the market got very long equities. January was unbelievable. You look at margin levels, you look at the call buying activity. I think the market got very long, so you're cleansing a lot of that out is point one. Two, you have the other dynamics around FANG that have created a lot of this volatility. Third, there's an interesting dynamic in the rates market. What is the Treasury market? Is it a risk-on, risk-off hedge? Yep. Or is the fact that you're going to issue so much and inflation is rising? If we weren't going through this, the rate markets would be higher. But it's pretty hard to sell a lot of rates when you know you've got what is a potentially volatile dynamic. So we get this counterbalance. If there's no news, rates can drift a little bit higher, and people think that rates will drift higher. But boy, it's a risk-off dynamic when you've got some of these headlines. So you get this counterbalance that takes place. The same thing in the currency market. Currency markets aren't that volatile either.
You're not seeing anything. You barely see anything coming to the Japanese yen off the back of all of this. Yardeni, someone messaged me earlier in the week, and it was really important. It was about the hierarchy of vulnerability, cross-asset. Now, typically you would think that high yield would come before investment grade, and that's not how things are stacking up. It's kind of going stocks, investment grade, then high yield.
Yeah.
Why is high yield so resilient right now?
Well, I think it's a diverse market. I mean, there are a lot of different kind of issuers there. Last time high yield really got annihilated was in 2014, 2015, when the price of oil took a drop and commodity prices dropped. You had a lot of the issuers of energy-related high yields seeing their yields go up dramatically. There just aren't those kind of pressures right now in the high yield market. And at the same time, I think there's a perception that if we do get a trade war, then we're certainly not going to get much higher interest rates, and we could have a recession. So maybe you want to own Treasury bonds, and maybe high yield isn't going to get killed that much if it just turns out to be a slowdown as opposed to a recession.
Mike Collins, your thoughts?
Yeah, I think a lot of the releveraging we've had in the economy are in the biggest companies, right? The Fortune 500 companies that can pick up the phone and call, their banker and issue $4 billion on the wire at 3 or 4%. And that's where a lot of the leverage has crept in, right? So you're seeing that leverage creep in investment grade. You're seeing everybody kind of shift from AA to single A to triple B, right? So you have this huge kind of cohort of highly levered investment grade companies that could be on the precipice of going to junk if you do get the slowdown. And I think the junk market has actually been a little more insulated.
I think the point that was made about the FANGs is not something that you see in the credit markets. The FANGs have kind of become a lot more volatile, and they're big, and they're in the indexes. So I think that's compounded the volatility.